There is a shift unfolding beneath the surface of the global financial system, one that rarely dominates headlines, yet quietly commands the attention of the world's most powerful investors. It isn't happening on the floor of the New York Stock Exchange. It isn't being driven by the latest earnings report. And it certainly isn't the story most retail investors are talking about. Instead, it is taking place inside central bank boardrooms, institutional investment committees, sovereign wealth funds, and the offices where billion-dollar portfolio decisions are made. The signals are subtle, easy to overlook, but history suggests that the most important financial changes almost always begin this way, long before the public notices, long before the headlines catch up, and long before prices fully reflect what is already happening beneath the surface. Throughout history, every major shift in wealth has started with a small group of investors recognizing something that the broader market either ignored or misunderstood. The housing boom of the early 2000s, the technology revolution, and the rise of artificial intelligence each rewarded those who focused on the underlying forces rather than the daily noise. Today, another question is beginning to emerge: why are some of the world's largest investors paying closer attention to silver? Not because of a single headline, not because of a viral prediction, and not because anyone can guarantee what happens next. The reasons run far deeper. They involve inflation, government debt, the future of the US dollar, artificial intelligence, semiconductor manufacturing, electric vehicles, renewable energy, and a global economy that appears to be entering another period of profound transformation. On the surface, silver may seem like just another commodity whose price rises and falls with market sentiment. But beneath that surface lies a far more complex story, one that connects monetary history, industrial innovation, investor psychology, and the long-term decisions of institutions responsible for managing trillions of dollars. Most individual investors spend their time asking one question: where is the price going tomorrow? Professional investors often begin with a different question: what is changing beneath the surface that everyone else has yet to recognize? That distinction has shaped some of history's greatest investment decisions. It doesn't guarantee success. It doesn't eliminate uncertainty. But it changes the way opportunities and risks are understood. Because in financial markets, the biggest moves are rarely driven by today's headlines. They are driven by long-term shifts that most people fail to notice until those shifts become impossible to ignore. And that brings us to the question at the heart of this documentary: what are billion-dollar investors seeing in silver today that much of the market may still be overlooking? By the end of this documentary, you'll understand why that question matters, and why the answer could have implications that extend far beyond silver itself. Most investors believe markets move because prices move. Professional investors understand something different. Prices are usually the final chapter of the story, not the beginning. By the time an asset captures headlines, trends on social media, or dominates financial television, much of the underlying shift has often been developing quietly for months, sometimes even years. That is why institutional investors rarely begin their research by asking, "What is the price today?" Instead, they ask a far more important question: what is changing beneath the surface? This difference in perspective separates short-term speculation from long-term capital allocation. For many retail investors, investing starts with a chart. If silver rises sharply, attention follows. Searches increase. News headlines multiply. Social media fills with predictions about where prices might go next. The conversation becomes centered on one thing: did I miss the move? Institutional investors think differently. A pension fund managing hundreds of billions of dollars isn't trying to predict tomorrow morning's price. Neither is a sovereign wealth fund responsible for preserving national wealth over decades. Their responsibility isn't to chase momentum. It's to understand structural change before it becomes obvious. That means looking beyond price and focusing on the economic forces that eventually influence price. They study monetary policy, government debt, industrial demand, global manufacturing, capital flows, interest rates, energy transitions, geopolitical risk, and technological innovation. Individually, none of these factors tells the whole story. But together, they begin to form a picture. And recently, that picture has become increasingly difficult for institutions to ignore. Silver has quietly moved back into conversations taking place inside investment committees, research departments, and macroeconomic strategy meetings around the world. Not because anyone knows with certainty where prices will go next, but because several long-term trends are beginning to intersect at the same time. History teaches an important lesson: the biggest investment opportunities rarely appear obvious while they are forming. When the internet transformed global commerce during the 1990s, most people viewed it as a curiosity rather than an economic revolution. When smartphones first appeared, few imagined they would reshape communication, banking, shopping, entertainment, and nearly every modern industry. Artificial intelligence followed a similar path. For years it remained largely within research laboratories. Today, it influences healthcare, finance, manufacturing, cybersecurity, education, and some of the world's largest technology companies. Every major transformation begins quietly. Only later does it appear obvious. Institutional investors understand this pattern. Their objective is not to predict every headline. Their objective is to identify structural shifts before they become consensus. This requires patience. It requires research. And perhaps most importantly, it requires the willingness to pay attention when very little appears to be happening. Silver represents one of those quiet stories. Unlike many financial assets, silver occupies two very different roles at the same time. For thousands of years, it has been recognized as a monetary metal, a store of value trusted across civilizations long before modern banking systems existed. Yet today, silver is also an essential industrial resource. It is used in semiconductors, electric vehicles, solar panels, medical technology, telecommunications, advanced electronics, artificial intelligence infrastructure, and countless manufacturing processes that most consumers never see. Few assets operate at the intersection of both monetary history and technological innovation. That unique position is one reason institutions have begun paying closer attention. Because when multiple long-term trends begin converging, they can create entirely new investment environments. This doesn't guarantee extraordinary returns. Markets never offer guarantees. Economic conditions evolve. Technology changes. Government policy shifts. Unexpected events occur. Professional investors understand uncertainty better than anyone, which is precisely why they spend less time making bold predictions and more time preparing for multiple possible outcomes. This is another important difference between retail and institutional thinking. Retail investors often search for certainty. Professionals search for probability. They ask, if several independent trends continue developing together, what assets become increasingly important? It's a subtle difference. But over decades, it can completely change how investment decisions are made. Because markets rarely reward those who react first to headlines. They often reward those who recognize the underlying forces long before those headlines ever appear. And that raises an even larger question. What exactly are these institutions seeing in today's global economy that has quietly placed silver back on their radar? To answer that, we have to step away from silver itself and examine something much bigger, the transformation taking place inside the global monetary system, and why inflation, interest rates, government debt, and the future of the US dollar may be shaping the next chapter of this story long before most investors realize it. If institutions are quietly paying closer attention to silver, the next question becomes obvious. Why now? The answer doesn't begin inside a silver mine. It begins inside the global financial system. Because before silver can experience a major long-term shift, something else usually changes first, the monetary environment. Every investment exists within a larger economic landscape. Stocks, bonds, real estate, and commodities do not move in complete isolation. They all respond, in different ways, to the decisions made by governments and central banks. That is why institutional investors spend so much time studying the economy before they study individual assets. One of the most important forces they watch is inflation. Inflation simply means that over time, money buys less than it once did. Imagine walking into a grocery store with $100. If that same basket of groceries costs $110 a year later, your money has lost some of its purchasing power. Nothing about the dollar itself has physically changed, but what it can buy has. For families, inflation affects everyday life. For businesses, it changes costs and profits. For investors, it changes how capital is allocated. And for assets like silver, inflation often becomes part of a much larger conversation. Not because silver automatically rises whenever inflation increases, history doesn't work that neatly, but because periods of persistent inflation often encourage investors to look for assets that may help preserve purchasing power over long periods of time. That naturally brings attention back to precious metals. But inflation is only one part of the story. The next piece is the Federal Reserve. The Federal Reserve is America's central bank, responsible for helping maintain stable prices and support a healthy economy. One of its most powerful tools is interest rates. Think of interest rates as the price of borrowing money. When rates are low, borrowing becomes cheaper. Consumers are more likely to buy homes. Businesses are more willing to expand. Economic activity often accelerates. When rates rise, borrowing becomes more expensive. People spend more carefully. Businesses become more selective. Economic growth usually begins to slow. The Federal Reserve constantly tries to balance two competing goals, supporting economic growth while keeping inflation under control. It is a difficult balancing act. Raise rates too quickly, and economic activity can slow more than expected. Keep rates too low for too long, and inflation can become increasingly difficult to control. Institutional investors understand that these decisions rarely affect only one part of the economy. They influence almost every financial market, including silver. Higher interest rates can make income-producing investments more attractive. Lower rates can increase interest in alternative assets. But experienced investors know the bigger story isn't today's interest rate, it's where monetary policy appears to be heading next. Markets constantly look forward, not backward. That is why every Federal Reserve meeting is watched so closely by professional investors around the world. Then comes another factor that has become increasingly important over the past decade: government debt. Governments borrow money to finance spending that cannot be covered entirely through tax revenue. Much of that borrowing happens through Treasury securities. Investors purchase these securities, effectively lending money to the government in exchange for interest payments. This system has operated for generations. But as debt grows larger, investors naturally begin asking new questions. How much borrowing is sustainable? How much interest will eventually need to be paid? And what choices might policymakers face in the future? These questions do not automatically create financial problems, but they become part of the broader conversation institutions are having, especially when debt, inflation, and interest rates begin influencing one another at the same time. That leads directly to the Treasury market. Although it rarely receives the same attention as the stock market, many professionals consider it one of the most important markets in the world. Treasury yields influence borrowing costs throughout the economy, including mortgage rates, corporate loans, business investment, and consumer spending. Nearly every corner of the financial system feels their impact. When Treasury yields move significantly, institutional investors pay attention, not because yields alone predict the future, but because they often reflect changing expectations about inflation, economic growth, and monetary policy. Finally, there is the US dollar. For decades, the dollar has served as the world's primary reserve currency. Global trade, international finance, and commodity markets all depend heavily on it. Because of that role, movements in the dollar influence assets around the world. When the dollar strengthens, commodities priced in dollars often face additional pressure. When it weakens, the environment can become more supportive for certain hard assets, including precious metals. Again, there is no simple formula. Professional investors avoid thinking in absolutes. Instead, they ask a broader question: how are all of these forces interacting together? Inflation, interest rates, government debt, Treasury markets, the Federal Reserve, and the US dollar are all signals. Individually, they explain very little. Together, they begin to reveal why silver has quietly returned to the discussion among institutions managing billions, and in some cases, trillions of dollars. But monetary policy is only half of the story. Because unlike gold, silver is influenced by something equally powerful: the future of technology itself. And that is where this story becomes even more fascinating. Up to this point, we've explored the economic environment that has quietly brought silver back into institutional conversations. But that still leaves an important question: why silver? After all, investors have thousands of assets to choose from: stocks, bonds, real estate, oil, copper, gold, and cryptocurrencies. So what makes silver different? The answer lies in the fact that silver occupies a position that very few assets in the world can claim. It belongs to two completely different worlds at the same time. One is rooted in thousands of years of monetary history. The other is helping shape the technologies of tomorrow. That combination is exceptionally rare. For most of human civilization, silver was far more than an industrial metal. It was money. Long before paper currencies existed, societies across the world relied on silver to facilitate trade, preserve wealth, and establish trust between buyers and sellers. Ancient Greece, the Roman Empire, Imperial China, medieval Europe, and the Islamic world, civilizations separated by oceans, languages, and centuries, all arrived at a remarkably similar conclusion. Gold and silver represented value not because governments declared them valuable, but because they were scarce, durable, divisible, and difficult to create. Unlike paper money, silver could not simply be printed during times of financial stress. Its value came from the effort required to discover it, mine it, refine it, and verify its purity. Although modern economies no longer operate on silver-based monetary systems, that historical role has never completely disappeared from the minds of long-term investors. During periods of uncertainty, precious metals often return to the conversation, not because history repeats itself exactly, but because history continues to shape how people think about money, trust, and purchasing power. Yet silver's modern story extends far beyond its monetary past. Today, it has become one of the most strategically important industrial metals in the global economy. Unlike gold, much of silver's demand comes from manufacturing. Every year, millions of ounces are consumed in products that power modern life. Most people never notice it, they simply use the technologies built with it. Open your smartphone. Inside are tiny electronic connections that rely on silver's remarkable ability to conduct electricity. Turn on a laptop, connect to the internet, charge an electric vehicle, or visit a modern hospital. Behind many of these technologies is a metal chosen not because it is precious, but because its physical properties are extraordinarily difficult to replace. Silver is the most electrically conductive metal known. It is also one of the most thermally conductive and reflective. Those characteristics make it essential in applications where efficiency and reliability matter. As the world becomes increasingly digital, those qualities become even more valuable. Artificial intelligence is a perfect example. Most people think of AI as software, algorithms, chatbots, and machine learning. But none of it exists without physical infrastructure. Every AI model requires enormous data centers filled with advanced processors, networking equipment, cooling systems, and high-performance electronics. All of that hardware depends on materials capable of transmitting electricity with exceptional efficiency. Silver quietly plays a role in many of those systems. The same is true for semiconductor manufacturing. Semiconductors have become the foundation of the modern economy. They power computers, smartphones, medical devices, automobiles, industrial machinery, satellites, and countless technologies that businesses and consumers rely on every day. As demand for advanced chips continues to grow, so does the need for highly reliable materials used throughout the manufacturing process. Silver remains one of those critical materials. Then there is the global transition toward electric vehicles. An electric vehicle contains significantly more electronic components than a traditional gasoline-powered car. From battery management systems to power electronics, sensors, charging infrastructure, and onboard computers, each vehicle requires sophisticated electrical connections. As production expands worldwide, industrial demand for highly conductive materials naturally becomes part of the equation. Renewable energy tells a similar story. Solar panels rely on silver because it efficiently carries the electrical current generated by sunlight. As countries continue investing in renewable energy infrastructure, solar installations have become one of the fastest-growing sources of industrial silver demand. Institutional investors understand something important: these trends are not isolated. Artificial intelligence, semiconductors, electric vehicles, renewable energy, and digital infrastructure are each growing for different reasons. Yet all of them increase demand for technologies where silver plays a meaningful role. This is why silver occupies such a unique position. It is influenced by monetary conditions, like other precious metals, but it is also influenced by industrial innovation, like many strategic commodities. Few assets respond to both forces simultaneously. That does not mean demand will always rise in a straight line. Technology evolves. Recycling improves. Manufacturing cycles fluctuate. Economic slowdowns temporarily reduce industrial activity. Markets remain uncertain. Professional investors recognize these risks. They never assume one trend guarantees a particular outcome. Instead, they ask a broader question: what happens if monetary uncertainty and industrial demand begin reinforcing one another at the same time? That possibility is precisely why silver has quietly moved back onto the watch lists of institutional investors. Because the story is no longer just about precious metals. It is becoming a story about the future of technology, global manufacturing, and the evolving structure of the world economy. And that leads to perhaps the most important question of all: if institutions are paying attention to these long-term forces, what specific signals are they watching before making billion-dollar investment decisions? By this point, one thing has become clear. Institutional investors are not simply watching the price of silver. In fact, price is often one of the last things they analyze. Before billions of dollars are allocated, professionals spend far more time studying the environment in which prices are formed. They ask a different question: what signals is the market sending beneath the surface? Because markets rarely move without a reason, and those reasons often appear long before prices fully reflect them. One of the first places institutions look is the Treasury market. Although it rarely dominates financial headlines, many economists consider the U.S. Treasury market the foundation of the global financial system. Treasury yields influence borrowing costs across nearly every part of the economy, including mortgage rates, corporate loans, business investment, consumer spending, and even stock market valuations. When Treasury yields begin moving significantly, professional investors don't simply ask whether yields are higher or lower, they ask why. Is inflation changing? Are growth expectations improving? Is government borrowing increasing? Or are investors becoming more cautious about the future? The answer matters because each scenario creates a different environment for financial assets, including silver. The next signal is the bond market. While many retail investors focus almost entirely on stocks, institutional investors often spend just as much time studying bonds. Why? Because bond markets frequently reflect changing expectations before stock markets do. They provide clues about economic growth, interest rate expectations, inflation, and overall confidence in the financial system. If bond investors begin adjusting their expectations, institutions pay attention, not because bonds predict the future with certainty, but because they often reveal how professional capital is positioning for what may come next. Liquidity is another signal that receives enormous attention. Simply put, liquidity refers to how much money is moving through the financial system. When liquidity is abundant, investors often feel more comfortable taking risk. Capital flows into businesses, markets expand, and investment activity increases. When liquidity tightens, investors generally become more selective. Financing becomes more expensive, businesses slow expansion, and risk appetite often declines. Institutional investors constantly monitor these conditions because liquidity influences nearly every asset class, and silver is no exception. The goal isn't to predict short-term price movements. It's to understand whether the broader investment environment is becoming more supportive or more restrictive. Then there are global capital flows. Money is constantly moving around the world, between countries, industries, currencies, stocks, bonds, commodities, and cash. Professional investors watch these movements carefully because they often reveal changing priorities. When capital begins shifting toward defensive assets, it may reflect rising uncertainty. When it moves aggressively toward growth sectors, it may suggest increasing confidence in economic expansion. Neither signal guarantees future performance, but together they help institutions understand where global investment sentiment is heading. Central banks also remain one of the most closely watched participants in financial markets. Not because they directly determine silver prices, but because their decisions influence interest rates, liquidity, inflation expectations, and confidence in the monetary system. Around the world, central banks continually evaluate economic conditions before making policy decisions. Institutional investors study those decisions carefully, not only what policymakers do, but what their actions may signal about the economy's direction over the coming months and years. Another area receiving increasing attention is investment demand through exchange-traded funds, or ETFs. ETFs have made it easier for both institutional and individual investors to gain exposure to precious metals without taking physical delivery. When investment demand strengthens, ETF holdings often increase. When investors reduce exposure, those holdings may decline. Professionals monitor these trends because they offer valuable insight into changing investor sentiment. Again, no single indicator tells the whole story. Every signal adds another piece to the puzzle. Supply is equally important. Unlike financial assets that can be created electronically, physical silver must first be discovered, mined, processed, and refined. That takes time. Developing a new mining project can require years of exploration, environmental review, financing, and construction before production even begins. Meanwhile, existing mines naturally become less productive over time, or grades change. Operating costs fluctuate. Unexpected disruptions can affect output. Institutions understand that supply rarely adjusts quickly, which means long-term changes in demand can take years to balance through increased production. Finally, there is industrial demand, perhaps the single most distinctive feature separating silver from many other precious metals. Demand doesn't come from one industry. It comes from many: artificial intelligence infrastructure, semiconductor manufacturing, electric vehicles, solar energy, medical technology, consumer electronics, telecommunications, and advanced manufacturing. Each sector may appear unrelated, yet together they create a remarkably broad foundation of industrial demand. Institutional investors rarely focus on any one trend in isolation. Instead, They ask a much larger question: what happens if several independent trends begin reinforcing one another at the same time? Monetary uncertainty, growing industrial demand, long development timelines for new supply, changing capital flows, central bank policy, treasury markets, and bond yields each tell only part of the story. But when viewed together, they begin to explain why silver has quietly returned to the attention of investors responsible for managing billions, and in many cases, trillions of dollars. Of course, no collection of signals can eliminate uncertainty. Markets remain unpredictable. Economic conditions evolve. Unexpected events will always occur. Which is why the most experienced investors never build their portfolios around a single prediction. Instead, they prepare for multiple possible futures. And that raises the final question: if the future cannot be predicted with certainty, what are the most realistic paths that silver could take from here? One of the biggest mistakes investors make is believing the future unfolds in only one direction. Markets don't work that way. Economic conditions change. Technology evolves. Government policies shift. Unexpected events reshape expectations. That is why institutional investors rarely build their strategies around a single prediction. Instead, they prepare for multiple possible outcomes. When it comes to silver, there are three broad scenarios worth considering. None of them are guarantees. Each represents one possible path among many. The first is the bullish scenario. In this environment, inflation remains persistent while governments continue carrying historically high debt levels. Central banks gradually move toward easier monetary policies as economic growth begins to slow. At the same time, industrial demand continues expanding through artificial intelligence, semiconductor manufacturing, electric vehicles, renewable energy, and digital infrastructure. Meanwhile, new silver production struggles to keep pace with long-term demand. If several of these trends develop together, silver could benefit from both its monetary role and its industrial importance. Notice the key word, could, not will. Markets rarely move in straight lines, but this is one scenario institutional investors continue to monitor closely. The second possibility is a neutral scenario. Perhaps inflation continues moderating. Economic growth remains steady. Interest rates gradually normalize without triggering a major recession. Industrial demand continues growing, but at a measured pace rather than accelerating dramatically. Mining production remains relatively balanced with consumption. In that environment, silver may continue trading within a broad range, responding to changing economic conditions without experiencing an extraordinary breakout in either direction. For long-term investors, this would represent a period where patience matters more than excitement. Then there is the bearish scenario. Imagine a period where global economic growth slows more sharply than expected. Manufacturing activity weakens. Demand for electronics, automobiles, and renewable energy projects temporarily declines. Industrial consumption of silver softens. At the same time, inflation falls more quickly than anticipated, reducing pressure on central banks. Interest rates remain relatively attractive, and investors increasingly favor income-producing assets over precious metals. If those conditions develop together, silver could experience periods of downward pressure or extended consolidation. Institutional investors acknowledge this possibility just as seriously as the bullish case because disciplined investing is not about proving one opinion correct, it is about respecting uncertainty. This is perhaps the greatest difference between professional investors and the average market participant. Retail investors often ask, which scenario is going to happen? Institutions ask a different question: if any one of these scenarios unfolds, is our portfolio prepared? That subtle shift in thinking changes everything. Rather than trying to predict every market move, professionals focus on building resilience. They diversify. They manage risk. They avoid concentrating everything on a single outcome. History has repeatedly shown that the future rarely unfolds exactly as anyone expects. And that may be the most valuable lesson of all. The investors who succeed over decades are not those who consistently predict the future. They are the ones who remain prepared for a future that no one can predict with complete certainty. That mindset, preparing instead of predicting, has guided some of history's most successful investors through periods of inflation, recession, technological disruption, financial crises, and economic transformation. It is a philosophy built not on certainty, but on adaptability. And that brings us to the final chapter. Because beyond every chart, every economic indicator, and every market cycle lies a much deeper lesson, one that history has been teaching investors for generations. Throughout this documentary, we've explored a question that extends far beyond the price of silver. It began with a quiet shift taking place inside the world's largest financial institutions, a shift driven not by headlines, but by deeper economic signals. Inflation, monetary policy, treasury yields, government debt, industrial innovation, artificial intelligence, global manufacturing. Each of these forces tells part of the story. Together, they reveal something much larger. Not a prediction, not a guarantee, but a changing macroeconomic environment that thoughtful investors cannot afford to ignore. Financial history teaches a lesson that remains remarkably consistent across generations. The greatest periods of wealth creation and wealth preservation rarely came from predicting the future with perfect accuracy. They came from understanding long-term trends before they became obvious. Every generation believes its challenges are unique. Technologies evolve. Political landscapes change. Markets rise. Markets fall. Yet beneath every market cycle, one principle remains unchanged: capital flows toward preparation, not certainty. That is why institutional investors spend so much time studying structural shifts instead of reacting to daily headlines. They recognize that successful capital allocation is not about knowing exactly what will happen next month. It is about building portfolios capable of navigating many possible futures. This philosophy explains why risk management has remained at the center of successful investing for decades. Diversification is not an admission of uncertainty, it is a recognition that uncertainty will always exist. No central bank can eliminate it. No economist can forecast every cycle. No investor can consistently predict every turning point. The objective has never been certainty. The objective has always been resilience. Markets reward those who remain disciplined when emotions are high and those who continue asking thoughtful questions when everyone else is focused on short-term noise. Perhaps that is the most valuable lesson silver offers. Not because it is unique. Not because it is perfect. But because its story sits at the intersection of monetary history and technological progress. It reminds us that markets are influenced by far more than today's price. They reflect confidence, innovation, investor psychology, economic signals, and the constant search for purchasing power in an ever-changing global economy. Whether silver ultimately outperforms or underperforms in the years ahead will depend on forces that no one can predict with complete certainty. What matters more is understanding why it has quietly returned to the attention of economists, institutional investors, and long-term market observers. Years from now, today's headlines will be forgotten. Interest rates will change. Governments will change. Economic conditions will evolve. New technologies will emerge. New market cycles will begin. But the questions that guide disciplined investors are likely to remain the same. Where is the world changing? What structural shifts are taking place beneath the surface? And how can today's decisions remain relevant in tomorrow's economy? Those questions have shaped some of history's most successful investment decisions, and they will continue to matter long after today's market narratives have faded. Because in the end, lasting wealth has rarely belonged to those who reacted the fastest. It has belonged to those who remained patient enough to understand the bigger picture. The greatest investors never knew the future. They simply respected uncertainty, studied financial history, managed risk with discipline, and prepared for more possibilities than everyone else. In a world constantly searching for certainty, that willingness to remain patient, adaptable, and informed may be the greatest competitive advantage of all. As this chapter closes, remember that this documentary was never about predicting the next move in silver. It was about understanding the forces that shape financial markets and the mindset that has guided successful investors across generations. Markets will continue to change, but disciplined thinking, thoughtful preparation, and a long-term perspective remain timeless. And perhaps, that has always been the most valuable investment of all.